Good morning, everybody. It's actually a beautiful Sunday today. I want to go over today what we've been seeing in the market over the last month. For those of you who saw my presentation last weekend at the HGS Investor Conference in Palos Verdes, you know that I was fairly bearish on the market. I went through a number of short sale ideas, which have worked pretty well so far over the past week. I also said that I was looking for something more decisive on the downside in the market, and we got that, I think, on both Thursday and Friday. So I want to go through that. Then I want to look at where we are now, what sorts of scenarios might play out over the next few days, maybe even longer, and where the opportunities might lie. Also, this webinar is going to replace Friday's webinar, which was, in my view, kind of lame because, number one, Dr. Hayes trying to massage a buy signal in the market direction model, which at that point in time the market was completely negating by reversing and blowing to the downside. And I was busy scrambling. I had covered my shorts early in the morning when everything just busted right away, and I got a bunch of MACD stretches on the downside on my intraday charts, and so that, for me, that was a time to take profits. But as they rallied up right in the middle of the webinar, everything started to roll over again, so I'm scrambling to get short again. And really was fairly distracted, and as somebody pointed out to me, what I should have done based on that is to just cancel the webinar at that point in time because of what's going on in the market. But, you know, I didn't want to leave everybody in the lurch given that the MDM signal was rather confusing because on Thursday morning we had talked about, in our pre-market pulse report, we had talked about the fact that we saw the market rally in the S&P 500 and the bounce back above the 50-day in the NASDAQ as a bull trap. And I saw it as a bull trap. To me, it was about as clear as day. And for those of you who've been in the chat room on a regular basis, when I come in and I tell you this, you want to short this rally, and I did that Friday morning, and then within a few minutes later, I see an email saying that the MDM has gone on a buy signal, which didn't make any sense to me either. But it is what it is, and I should let you know that I've talked this over with Dr. K, and he told me this morning that the model will switch back to, I think, at least a cash signal. You know, and then of course there's the old saw about QE will put a floor in the market. Well, my argument would be that you don't know, and you can't operate on the assumption that there's going to be a magic floor showing up, because as far as I'm concerned, if you look at just about every hot leading stock, every high PE, high flyer, as I like to refer to them, over the past month, they've been decimated. So there's no floor for them. And if you're in stocks, I think that you're just asking for a lot of trouble. And I've pointed out many times to people on these webinars and other places that Can Slim and O'Neill style investing, while it can be very profitable when it works, when it stops working, you can get your head handed and maybe a couple other parts of your anatomy as well handed to you as everything gets chopped to pieces. So, you know, you have to be careful, and I think getting complacent and assuming that there's some magic force in the markets that's going to fix everything every time around, I think is a futile effort and basically a recipe for disaster. So in my view, you don't want to be paying too much attention to the MDM, I think, and also you want to focus, as I've said many times, forget the indexes, screw the indexes, watch the stocks, because the stocks tell you everything you need to know, and they do it well before the indexes do. It's just that kind of a market. I also think my premise is that I believe in this sort of QE distorted market, you have action, price volume action that is in contravention to everything we've seen over the last century, and so trying to create a model that issues signals based on facts that are now not irrelevant over the past 70 years or however many years you want to go back, it's just not relevant, and I think it's just a recipe for disaster. You really have to be much more nimble, and you also have to be thinking a little bit outside the box, and that's something I've strived to do, and I've talked about using HGS Investor software as one of my tools, and of course you can see the chart here of the S&P 500 reversing on an outside reversal day on Friday after sucking everybody in. For those of you who are on the chat room, you know that I said you want to be shorting this morning futures jack. These have been occurring over the last week or so with regularly, and you've seen, like in here last week, we saw several gap ups that stalled out. The NASDAQ, let me pull up the NASDAQ chart. It's here somewhere. There it is. No, that's not it. There she is. The NASDAQ was doing this along the 50-day last week where it was trying to gap up. Let's blow this up so you guys can see this really well. And you can see you try to open, in this case you open up, close down. Here you opened up and closed lower here. The third day of this churning along the 50-day, you opened up here on a fake out gap up, and then you rolled over on heavy volume to the downside and broke the 50-day. Then you rally back above the 50-day, which to me makes sense given how oversold things had become. So you start rallying back up. You're stalling along the way. You get a good day here, and then here's the bull trap day that we had pegged. And you reverse. Volume was not so heavy, but to me, relative to the prior day, so Thursday's volume compared to Wednesday was not so heavy. So to me, that really implies that there wasn't enough demand to drive the rally further. And so, the S&P going to new highs, in my view, is just based on the fact that what we've been seeing over the past month is a rotation out of these high PE, high flyers as they've just been crushed, and a movement into lower PE, big, old line, established, big cap names. And so you see money flowing into stuff like Microsoft. I see money going into Intel. A lot of that seemed to stop on Friday. But it looks to me like there's a sea change where institutions are pushing into these low PE big caps, and what they're doing is they're hunkering down, they're battening down the hatches and getting ready for something that is going to bring the market down a lot more than it's come down so far. That's what it looks like to me. Okay, and you can go on and on about QE putting a floor in the market, but as far as I'm concerned, the way I trade and the way I focus on individual stocks, it's all just a bunch of BS to me. QE is there, yes, and it will generate a rally at certain times when the market hits a floor. But here's what's very much different this time around compared to prior corrections. And I'll go back. If you recall, we had a correction at the end of January. And for those of you who follow me on the chat room, I said this day was a sort of a follow-through and a turn in the market. And what you saw as the market was correcting, you saw a number of stocks. I'm going to take a look at some of these. Let's just go to you look at Facebook, for example, and this is late January. It was actually gapping up. As the market was coming down, it was gapping up and holding above. Coors was doing the same thing. You can see that. You had stocks like YY was coming up and then pulling back and holding above the 50-day and setting up, and then towards the middle of February we began to see it get real tight in here, and you saw this tightness back in late December, but again it got tight again and moved higher. So back then stocks were pulling in, okay, sure, and this broke out and pulls back to the breakout point, which is pretty standard, but that's where it finds support. And this time around it hasn't. You look at YY now, it's busting through, and in fact you have a close here below the 50-day, and now you're violating the 50-day. I don't know if this turns out to be a double bottom and we try and rally out of here. That's something to keep an eye on. But you can see the thing is going code red, everything turning red here. You're getting a little baby kahuna or a little red kahuna there, a pink kahuna, whatever you want to call it. Somebody's asking, what are the blue bars on FB? These blue bars here are pocket pivots. This is an overlay. I should actually, you know what? I'm just going to confusing all of you guys. Let's see. So what I'm going to do is I'm going to switch. There we go. Let's use that. I'm going to check one thing here. Let's see. Yeah, okay. So if we look at Facebook, for example, as another example, when it pulled back as the market was correcting, it actually it was just testing the lows of the Bible gap up day here. But now it's violated the 50-day. You tried to rally up towards the 50-day on Wednesday, but then you failed at the black 65-day exponential. Now it's going code red. And it's starting to break down, and it looks to me like it's going to at least test maybe this low of this gap here, or maybe it's going to the 200-day. I wouldn't be surprised if it did go to the 200-day, because what you're seeing in a lot of these stocks is a left shoulder. Here's a left shoulder here. You see that? And then this would be your big head. And now you're coming down. So if we look at a weekly chart, let's pull up Facebook on a weekly chart, you can see what I'm talking about. Here's your left shoulder. Let's blow this up real big. You can see the left shoulder, and you might even say a couple of little tiny left shoulders, maybe a left shoulder with a little zit here or something, and then a big head. And you have the big breakdown along the right side of the head defines the right side of the head. So you've got that going on, and that's coming off the peak. So this looks like it's in a short-term topping pattern. Now, you can extrapolate this out and say that, okay, you're starting to form a neckline somewhere in this area, and notice that the 200-day or the 40-week moving average, which is moving up, looks like it might meet up with the price somewhere between here and 52 as it's rolling up. Maybe it flattens out a little, maybe more like 51. But it looks like you're coming down for that line. So what this implies to me is in order to complete the right sides of these heads, some of these stocks need to come down a little bit further. Some already have, and I'll get to some of those. But I could see this coming down to the 200-day line, 40-week line before it bounces, and then it would start to form a right shoulder. And if you go back and study Chapter 6 of our book, Trade Like an O'Neill Disciple, how we made 18,000% in the stock market, I think we should have another book, how we lost 50% in the stock market. That might be useful as well. Maybe that'll be one of our later editions. But in any case, that book, Chapter 6, shows examples from 2008, which was the last brutal bear market, actually late 2007 into early 2009. And you can go back and look at names that topped out back then. Let's take, for example, okay, you're going to be difficult. Let's go to all securities here. When we look at Crocs, we're going to go back in time here. And we'll go back to 2007. Here's where Crocs broke. The market topped, if you guys all recall, I'm sure you all do, in late October of 2007. That was a peak in the market indexes. Some leading stocks like Apple continued higher. And you could see that, but you know what's interesting? You don't really see that in any of the high flyer leading stocks right now. It doesn't look like anything wants to push higher beyond what could be a market top, at least short term. I mean, I think you're at least correcting more than the 7-8% that we've seen in the past. That's what I'm guessing. But you know, again, I'm not going to adopt a rigid view. I'm just going to let the market tell me its story. But you can see here that the right side of the head, boom, all the way down to the 40-week, and then a little bounce the next week, and then boom, through it. Okay, so you might see some of these stocks come down and then even go below the 200-day. You're seeing that in names like Workday, for example. But just look at this and see how this plays out here. Then you get a rally. Now this coincided. The market broke down off the peak in October and came down in early November, and then from there it tried to rally, and then it rolled over again in January. So what happens is the market comes down, and then of course if we extrapolated this out to today, then this is where the QE floor comes in. But I don't know if the QE floor leads to a new bull market. It may just lead to, in fact, I doubt if it does. I think what will happen is you'll see a snapback rally, and it might be tradable on the long side. So you definitely want to be following me on Twitter as well as in the chat room if you're interested in following some of the names I might try and trade. I tried to trade a couple of names on Friday, Workday at its 200-day and Tesla at the 10-day, but I blew those things out pretty quickly because they just didn't hold, and I don't give them much room if I'm trying to buy into the the whole falling knife sort of thing. But you will get sharp snapbacks, and I do plan on trying to play some of those on the upside, and we'll just see how that develops. Right now, it looks to me like we're going to head lower. So, we had 1 week. This week we broke off the peak in a lot of these names, or we've been doing it for the last month, and now a lot of names are down near their 200-day moving averages. Let's look at, there's Netflix. Okay, so Netflix could come down a little further, fake everybody out, come down and say 324, everybody gets really bearish, but really all it's doing, here's the left shoulder, here's a head, all it's doing is completing 2/3 of the head and shoulders formation, and then you're going to get a sort of an exhaustion low as everybody panics out of the market this week. I was surprised not to see that the put-call ratios did not get very high in the midst of Fridays. What really was an ugly day, and I think it's the worst sell-off in the NASDAQ in several months. So this is a lot different than the other sell-offs we've seen in the market over the past year, where things start to look ugly, but in fact, underneath the hood, there are a number of leading stocks acting normally, and those are the ones that come out before the market really starts to turn. It becomes obvious to everybody, and the market direction model goes to a buy, and IBD goes to a market in confirmed uptrend, blah, blah, blah. I mean, IBD went to a marketing correction on Wednesday, and then they reversed their signal on Thursday. And then, of course, we talked about a bull trap on Thursday, and then on Friday the MDM comes out with a buy signal. But I just want to make it clear, the MDM has nothing to do with what I think about the market. I don't use it, and I don't think it's really relevant during a period where it really just pays to watch the stocks. So with this happening, Netflix coming down, you can see that. May go a little lower. Look at workday now, left shoulder, big head. Now you've come underneath. And notice you're close to an area where you might look at a bounce here. And I look at this on a daily chart. I'm going to switch here. You can see you're coming down. You're getting the oversold bar. You're coming down in here. Maybe you come down a little further on Monday. Maybe you undercut this low here. Maybe this low down here. Here we go. Yeah, this low here, or possibly get down to this low. It really depends on how bad things get. I mean, some of the old timers, guys who were around in the late 80s and saw the crash of '87, Black Monday, told me that that occurred after a day like Friday. So we'll see what that brings. But all I know right now is I don't want to be long this market at all. And I've got some short positions out for Monday, but I have to admit I was scrambling to re-short. It was kind of a double dip day on Friday on the short side because you could have covered very quickly on in the morning as the market reversed, and then the bounces turned around. They actually produced real quick 620 buys, and then they reversed down into 620 sells. And I'll just give you an example real quick of here's LinkedIn. This has been one of my big shorts for a long time now. But you can see this was Friday morning, and you can see how you get the break like this. You see the MACD stretch, you're getting down there, and that's a deep MACD stretch. So for me, that's usually when I'm looking at covering. So what I'll do is if it's down like that, I got a MACD stretch. The first bar, the last bar here, if it gets above the peak of the bar on the candle wick there, then I just start covering. And that actually paid off. And then you almost got a buy signal right here, and then it failed. And then as it's coming down and we're starting the webinar, I'm looking at this thing. I got to get short this thing again because it looks like it's going lower. And by the end of the day, we were down much lower than the 172, 173 level right during the webinar, and closing around 166, somewhere around there. But it looks pretty grim here. I think LinkedIn is one of those stocks that'll probably go lower. What I'm looking for here is, whoops, a little too fast there. You can see this low here is that's around 160.03, I believe. I'm looking for it to undercut that. You can see it's starting to get oversold. Whenever it's gotten these oversold bars, it gets pretty close. Usually what has happened when you see the first one is you undercut and you move lower the next day and then turn around and try to bounce back up from there. So maybe we go zoop down here and then it tries to turn around and rally back into what I think is a neckline. Because this across from here, let's see if I can, where are my annotation tools? Let's do that. Okay, I got to say I've never used these before, so we're going to see if it works. There we go. There's a neckline. And so it's broken this neckline, and so there's potential for it to undercut this low here and then rally back into there. So if you're short LinkedIn, and I've been talking about this since it's been up here on the chat room, everywhere else where I discuss the market, on other websites and on Twitter, etc. And I think what you'd be watching for here is a break here and see if it rallies back up into the neckline where it would become shortable again. But to me, this is a long-term topping pattern. Big rolling mountain range kind of head and shoulders with a number of, I would consider this a left shoulder, then here's your head, and then you get like a second sort of head because this gets very close to the highs, and then you're just rolling, but never really able to get significantly above the 50-day following it down. But notice how it fakes everybody out on the rallies. Even here, this looked like a pocket pivot. Turned out to be a bunch of BS. This is another one that looked like a pocket pivot. And it's faking you out the whole way. And but you can see how it doesn't stop right at the 50-day, and it's one reason why you have to be flexible when you're shorting into rallies. You have to be flexible about coming in and testing them, and hitting them. If they keep going higher, then you cover, and then you try to hit them a little higher. And eventually the things blow apart. Hopefully by that time you're short a huge position and you make up all the nicks that you got, saying something like this on the short term. But this thing was pretty easy. Once you got to this point here and you were below the 200-day moving average, LinkedIn became very easy to play. And you can see it went code red here, right there at near that peak, and it's blown apart ever since. Other names that I talked about, let's I'm going to clear all annotations. And we'll go to Gilead. And, I gave you guys Gilead during a webinar right here on this day. And you can see here it comes down to the, comes down to what I think is probably a neckline here. and also the 200-day. So you see how those coincide. So you're seeing this in a lot of names as they're coming down. And I mean, these things have just been decimated over the last month. So you're seeing all this happen. And then you bounce off the 200-day. So what I'm looking for is some of these names may go a little bit through it and then bounce up to the line, or they may not go through it very much at all and then bounce off the line as Gilead did. And then you're looking at shorting. Look at this. It comes actually into the 20-day, and it stalls here, and now it's rolling back over. It looks to me like it's heading back for the 200-day. So this is definitely, I think, a top. I think the whole biotech space has topped. Let's see. I got to go back to all securities. Look at Celgene. Same thing here, but notice how Celgene came down. You basically get a neckline like this here, and you got left shoulder ahead. You got the big volume coming down the right side, defines the right side of the base. Let's look at this real quickly on the weekly chart. So you can see here's your left shoulder, the head, and you see the high volume defines the right side. I know a lot of you guys think you're seeing a head and shoulders, but if you don't have this big volume down the right side, in most cases it's probably not valid. But you can see here that it's blown completely through the 40-week line. You're getting a black cross now. I mean, this thing is so toast, it's not even funny. And you could have been on it on the rally earlier in the week. Yeah, I've been trading all of these things. It's just been a very glorious last 4 weeks or so on the short side, I have to say. And mostly, yeah, I'm going to say the last 3 to 4 weeks. And you can see that Gilead gets oversold, which leads to a rally right back up into, Celgene, right back up into the 200-day. And you could have shorted again there on Wednesday, and of course that would have worked beautifully over the next days. You could even shorted it on Thursday and done reasonably well on that. Now you're undercutting this low and you're going to new lows. It looks to me like you might be heading for this low here. That's what it looks like. But I think if you're short, you should already be short this thing. You can't really be shorting a lot of these now. But you can see, again, a situation where a stock that really has underperformed throughout 2014, so we start the beginning of the year, I guess somewhere right in here, and it's never gone anywhere. It just kept rolling, rolling, rolling. Gilead was the same way. Oops, that's gold. And Biogen, same thing. Now, Biogen might be a little sooner. It's probably headed for the 200-day. That's what it looks like. But you can see, again, the same pattern, left shoulder, big head, and maybe some right shoulder. So the scenario might be that we break down this week, and that takes a lot of these names either down to the 200-day line or through, as in the case of, say, something like, let me take a look at data, which I think, you're undercutting. This looks like it wants to try and turn, but it really couldn't. It got some support at the 200-day, but my guess is it may just continue to crash through. If we look at it on a weekly chart, I mean, this, I don't know what you call this. It's a big shoulder, a big head. There's really not much of a left shoulder. Generally, the left shoulder will occur somewhere after the stock's had a move, and this thing hasn't even had a move. But look at how ugly that is. But it could go beyond the 40-week line, and that's what we might see in a lot of names now. And then this would generate rallies, say in the case of Workday, maybe back, so maybe it goes down, below somewhere in here, and then it rallies up into the 40 weeks. So then you'd be watching that action to short at the 40-week line or the 200-day, depending on whether you're looking at the weekly or the daily chart. Or you might get a situation this week where a stock like Facebook, in a continued phase of market weakness and maybe an exhaustion, panic sort of sell-off this week, if that happens. And we don't know what's going to happen, and you don't have to know what's going to happen, but you can see what's happening, and that's all I need to know. So just remember that Cheech and Chong movie, I think, Born in East LA, where he's trying to teach the Chinese guys who want to try and immigrate into the U.S. through Mexico how to act like they're Mexicans. And so he's like, just go around and what's happening? So all you need to know is what's happening right now, and you don't need to know what's going to happen. You don't need to know that QE will put a floor in somewhere, and so don't ever get bearish. And you don't need to know even what the market did last month or throughout the past year, because we know that there have been several sell-offs, and we know that when the markets looked ugly, the market has turned around. But there are some very qualitative, and I might even say quantitative, differences going on right now versus every other sell-off over the past year. The primary one being the fact that we've seen this movement into these lower PE big cap names. It looks defensive. In March, the leading sector of the market was the utility sector, according to FinViz. And then that was followed by basic materials and consumer goods. And so these are defensive stocks. And, we saw the food stocks rallying about a week ago. So money's moving in there. Meat stocks like Tyson Foods and Dean Foods, and then egg stocks like Cal-Maine all rallying and going bonkers to the upside. But, that was a major factor. And the other factor here is that the leading stocks, there are no leaders that I can see that are quietly going about their business of setting up for when the market turns and holding above A, their breakout points, or B, key moving averages like the 50-day moving average. We're seeing a lot of violations of the 50-day moving average among leading stocks like Facebook, for example, which continues to go lower. So I might expect it to undercut this low, bump into the 40-week line, and then it tries to rally. So we get a short-term low in the market. Maybe the market direction model goes to a sell right here. I don't know. Hopefully it doesn't. But we got to be honest, it's a lot like IBD's market calls. It has functioned more as an oscillator rather than a decent timing model in terms of telling you where the new direction of the market is. I mean, IBD's been pretty wrong, and as somebody emailed me over the weekend, someone who is actually a professional who you'll see on TV, but I won't mention his name, he's a friend of mine, he said that his rule is whenever IBD goes to marketing correction, you just buy the crap out of everything, and that's worked pretty well. Of course, this time around, it may not work so well. So I think, we're looking primarily at the market developing into a short sale environment or short selling environment rather than a going long. So I'm going to go through some questions so I can just keep up. And we're about 26 minutes into the hour now. Someone's telling me the obvious. The webinar last Friday was not posted on YouTube yet. It's not going to be because there was a glitch in it, and it was a lame webinar. There was nothing useful about it. The market was in a state of extreme flux at the time. There was nothing really clear. I was watching things to see if I was going to return to the short side after having taken some nice profits early in the day. And the MDN was giving a bizarre buy signal. There's no way you can look at the chart of, the S&P 500 and say that's a buy signal, even though it's, even if it is the better acting index, because now you're one rally to highs, two rallies to highs, third rally to highs, it's 3 and out. Either use the rule of 3, means the third one is going to work. If it doesn't, to me it's 3 and out, and that's what I'd be looking for. So that webinar is not going to be posted. It's useless, basically. Somebody says, who was there, stocks actually look worse than at the Paulus Verdes meeting. Thanks for doing this. They do look worse. They're down lower. So, so the comments I made at the conference, Dr. Jeff, turned out to be pretty prescient. But I think most of the people at these conferences, HGSI crowd is a pretty sophisticated crowd in general, and most everybody there could see what the writing on the wall. The system has been showing you where the strength in the market has been, which has been primarily in defensive stocks and low PE stocks and big caps. I mean, that's one of the things that's just glaring at you when you look at what's been going higher. Well, the leading stocks get decimated. Somebody says, when is it too late to short something like Workday? Well, I mean, what's interesting, I'm going to show you something about this market. Everybody knows about the Livermore century mark rule on the upside. So that is when something goes through 100, 200, 300, 400 for the first time, not for the 5th time. Okay, somebody was asking me the other day if Intuitive Surgical is a Livermore century mark buy. But again, that's just Livermore's general rule, and what he used to observe was that stocks would go through the century mark. So let's just take 100 as an example in data. So you can see the stock gapped up, very strong gap up move. I played this stock. But I played this move, and that was it. It got up just above the 100 level, and then it reversed. And I was on the chat room in one of these days in here, letting everyone know that I had shorted Data and Workday and Yelp as well, because they were Livermore century mark rule in reverse plays. So Livermore, and you can read Reminiscences of a Stock Operator where he talks about shorting Anaconda Copper after he had bought it as it came up to the 300 price level for the first time. And when it did that, he was expecting it, he figured it should be like 320, 330, 340 in a hurry. And what it did is it faltered around like 308, 306, and then it started to come back in. And he surmised at that point, this is 1906, that the movement was false, and so he used the rule in reverse to go short. So he used the same thing here. And this is how one of the few ways I will short a rally or a stock that is not forming a head and shoulders and actually, you know, previously beaten down. So to me, this was shortable. A data was shortable up in here, and it's come down. You violated the 50-day shortable on all these moves. Very nice, you know, blow apart here. Even as the S&P is supposedly holding together. You're asking about workday. It's too late to short it. I mean, obviously, what you're looking at here is it may go, as I said, if we get a panic sell-off this week, and that's still an if. You know, the futures don't open for another for another 4.5 hours here on the West Coast. Well, everywhere I think. But in any case, if the futures are showing a big blowout to the downside tomorrow, you could get a panic low either tomorrow or Tuesday, and then you would have a sharp rally. I mean, the Black Monday in 1987 worked out the same way. You blew apart for a day or two, and then you had a sharp snap to the upside, but then that just led to a big bear market. And so, you know, this is too late. And I'm going to get to, you know, what you can short now, because we've seen the first wave of high PE, high flyer leaders get whacked and break down to form what are now almost completed heads in what could be head and shoulders patterns in process, okay? So somebody says, is this a beginning bear market in your opinion? Well, opinions are like buttholes. You know, everybody's got one. Is butt a nicer word to use than the other, but the A word? I don't know. Is this a beginning bear market in your opinion? I think there's a good probability that it is. I say better than 50%. But I play it as it comes, and all I know right now is that March was very profitable on the short side. And I mean very profitable. So, I mean, not like May 2010 when I was able to go up 85% in a month, but it's been pretty decent. So, what are the blue bar? Okay, we already answered that. You know, the other things, you have questions about the system per se, contact the guys at HGS Investor. And I'm not customer service for them. So, and they've created some chart views and things that are useful, I think. The pocket pivot one where you see the blue horizontal bars wherever there's something that roughly matches the criteria for a pocket pivot is not that accurate. Well, all it does is it highlights what looks like a pocket pivot on the chart. So if you don't have a real sharp chart eye or you're developing your chart eye, it's helpful in helping you at least get to them right away. Because I'll go through a chart and I'll see, oh, you know, this looks like a pocket pivot right here. What's going on? And as I look at them closer, and I say, okay, that's not a pocket pivot. That's extended at this point. This one was, you know, and I'll go through that. And this allows you to do the same thing because it highlights what meets the basic criteria of a pocket pivot, but it doesn't get into the nitty-gritty of determining if it's exactly right, okay? So it's just a useful tool for helping you develop your chart eye. Now, the gray bars are just oversold bars, and I found them pretty useful in giving me some idea when we're getting close to a bottom, and I use that in context with where the stock is on the chart position, etc. So, when you have time to address it, I have not seen a recording of Friday. Well, I already did. And somebody asked your thoughts considering some stocks forming left shoulder and head. Do you think there may be one more rally to form a right shoulder? That's what I'm looking for. But some of these stocks, you know, as they're coming into their price targets, I cover them. I don't try and guess what's going to happen. Let's go to. So, for example, Pandora, you know, I was shorting this one up here, 35.36 around the 50-day, and those of you who are on the chat room know that that was the case. And it undercut this low here, so I went and covered it. It rallied back into the 65-day. Juicy short the last couple days, and then you could have hit it again on Friday, or I'm sorry, on Thursday, and it just blew apart. Now you come down to the 200-day here, and you got a couple oversold bars in here. So for me, that's kind of getting played out. The other thing is you see a left shoulder, and this looks like a head, and I don't know if you should probably bounce off here, maybe go up to 30. That might be a spot to short at the highs of Friday, but I'll cover that, and that one's done, okay? Right now with LinkedIn, as I said, I'm looking for a move below this low here, which is about 160, and it might go a little further below that, and that would be where I might cover it and then look for a rally. Hopefully it doesn't just go down to 100 in one day, but you know, who knows? If we crash, these things could come off a long ways on the downside. So, what is the downside of going with the flow, the conservative low PE, slow-growing stocks? Well, the downside is that it's a defensive move. Okay, it's not new leadership. And I know, IBD talks about this being constructive. They don't know what they're talking about. It's a defensive move. Institutions are hunkering down. So big deal. You want to buy, let's buy the financials. That's a great area of new leadership. Well, they reversed on heavier volume on Friday, and they're starting to look kind of code red to me. And this hasn't really been an area of new leadership. You look at a lot of the financials. Let's look at Goldman Sachs. Those are head and shoulders. This thing to me is a short here. Use the 200-day as your stop. That's a short. If you want, you could use the high Friday, which is, let me see here, 167.04 as your stop. Stock closed, though, at 163.24. That's a little too high for me. But I think, I'd use a 200-day roughly around 164, I guess a little higher than that. I think it's 164.36. But, this looks like a short to me. Head and shoulders formation. You get the big break down the right side. And here is a leadership role that Goldman Sachs played earlier in the month. You got a sharp rally back above the 50-day, and then it just rolls over from there. And if you look at relative strength line, I do have a chart on HGS that has that, but I'm not going to start looking for it now. The relative strength is actually making a lower low, and it's been making a lower low for some time. So this has really been an underperforming area of the market. I think if financials were really leaders, then you would see the big stock financials leading the charge. You look at Citigroup. Citigroup, another head and shoulders type formation. You got a gap down here going code red. Gap down here, you form a little bear flag. Looks to me like you're going to drop out of this thing. These stocks announce earnings not this week, but the week after, I think on Monday and Tuesday on Citigroup and Goldman Sachs respectively. But this looks bad to me, and this looks like it wants to go lower. So I don't see any strength here in financials. You look at a Wells Fargo. Okay, it's one of the better banks. It's acting okay, but for all we know, that's the top. So that's been one that might be a leader, I guess. Let's see. I'm trying to come up with some others. Some stocks I'm watching. I think the REITs. They've all been coming back after a big, massive breakdown last year. Okay, and that's a brutal breakdown. But they've got a lot of fundamental problems, and I'm watching these names like this to see if they start to reverse and break down off their peaks here. So failed breakouts might cause me to get aggressively short on something like this. But it's another component of financials that you've seen, supposedly representing the strength and the new leadership in the financial. But it ain't happening as far as I'm concerned. In my view, if you were going to have that, you would see leading stocks like Morgan Stanley is breaking down. To me, this looks like a late-stage failed base. It looks like a short. So look at Schwab. This was a stock that was a leader in the group. So, I would expect stocks that had been acting strong and were either forming bases or setting up or pulling back to their 50-day moving averages, they would continue to act strong. But notice Schwab tries to break out here, and what happens? You immediately fail. So now what's going on here? This becomes a possibly late-stage failed base for Schwab, and look at that break. That's brutal. So there's a leading financial for you that is no longer leading. It's flailing and failing. So I don't see it. If we look at the stocks, and I never saw it. But it just goes down. It boils down to the fact that you don't want to rely on lowly paid newspaper writers for your investment advice. You can learn from some people, I think, but ultimately you need to develop expertise yourself. You need to develop a feel for the market yourself. You need to develop your chart eye. You need to put the work in to find the names that are suited both to your psychology and to your methodology, given whatever you see developing as either an uptrend or a downtrend, and in this kind of market, regardless of what the indexes are doing. So, but getting back to that question, one of the points I'm trying to make is that I think you may be within a couple days of a panic low, and I guess my HGS is flipping out on me, because you're seeing a lot of these stocks getting to near their necklines or their 200-day moving averages, and so you're getting close to an area where they might bounce, but they could go down another 10%. So, you don't want to be piggy on the short side, but just have an intelligent strategy for exiting. Now, this is a SOX. And the semiconductors suddenly were an area of leadership. But if you look at the SOX, semiconductors really have been leading since the beginning of the year. They've been trekking higher. Nothing spectacular. Most of the group is not all that spectacular. I think, what was that one? FSL. Whoops. Freescale is probably the hottest one, but it's a smaller name and it's done really well. But now it's breaking down. You look at the big stock semiconductors. MU hasn't really gone anywhere, so I don't know where leadership here. That is looking like a short, left shoulder head. I don't know. It's kind of a blah stock, But I've also looked at names like Sienna. I pointed out to everyone, I think on Thursday, that I was shorting Sienna on the BOP above the 50-day moving. Look at that nice bust. Now you've undercut, so that's kind of a cover in here. See if it rallies back to the turn of day. But that's that's a big move to the downside in one day. And if you're short 100% position, that's a very nice pump to your portfolio. So if you know how to handle it. And the one thing I like about a stock like Sienna is I've noticed you can actually come in with and pop 10,000 shares at a time, and you might budget 3 cents. So it's trades pretty liquid. As it starts moving down, though, it's hard to get a short off because they're pushing it down so fast. However, so the bottom line again is that there is the downside of going with the flow, and if you think that there's a movement into big caps as a flow, you're just showing how inexperienced you are. So take that to heart in a positive way, and understand that when the institutions start showing that they're moving into a defensive posture and hunkering down, then that means they're just getting ready for everything to come down. So the downside is that everything comes down, including the so-called safe stocks. The idea for the institutions, however, is that they're not going to come down as much as, say, a Netflix or a Tesla or a Facebook or a Workday or a Tableau software, all these other things that are blown to pieces, Silver City, whatnot. So that's the downside. So, and there is no worst case of 5 to 10% returns, So get yourself a medical marijuana prescription and look at your charts upside down, and maybe you can imagine that you've got 5 to 10% returns in what are essentially defensive stocks. It ain't going to happen. Somebody says, I love your brutal honesty. The MDM has had a tough time. Yeah, it has, and I don't have a problem with it, aside from the fact that we know how it acts. So you got to take it with a grain of salt. If you're some moron who thinks that it's this panacea that is like, God up on high telling you, buy stocks here, sell stocks there, and he knows everything, and he knows what the future is going to be. It's not, and so, but it is a contextual tool in my view, because I think when things get oversold, the MDM wants to go to a sell signal, and IBD wants to go to marketing correction. That's a low, and vice versa, and it's just the way this market is. And once you sort of understand that, I think you can handle the MDM better. In my view, is if you had gone with the buy signal on the MDM on Friday, you've got to exercise, I think, some sort of tighter stop policy than just waiting for a neutral or sell signal. I would say if you buy, in my view, if you go to a buy signal, that buy signal should be confirmed relatively quickly. If it's immediately negated with a big outside reversal on heavy selling volume, then just blow out. And if you go back up to the highs, then you can come back in. You might be getting in 1% or two higher on that particular ETF. But, I think if you bought the Qs on Friday, I think you got whacked pretty good. So, I'm not a fan of models. I think the whole process is it's entirely antithetical to the way I invest. I'm a tape reader. I try and shift with the market. I try and adjust to what I'm seeing. I watch individual stocks, and I don't try to look at some macro view that's going to guide every decision I make. I mean, I can be short and long at the same time. I can be long and short at the same time. I can be heavy long or heavy short, depending on how things are moving, and that can be all independent of what the indexes are doing. So I hope you and Dr. K are not in dispute because of bad MDM signal. Well, no, not really. We don't really go there. So, I mean, we disagree a lot. We used to disagree at O'Neill and have some very spirited arguments. Dr. K would come over to my house, and we'd crack open a bottle of nice red wine, and he'd get instantly or automatically a default invitation to dinner, and my wife would sigh and shrug her shoulders like, okay, and he would stay for dinner, and then he'd hang out till 9 o'clock or something. And we'd be rapping about the market and arguing. I mean, we differ a lot. Our view is that if we have a two-man team, then there's going to be times it's very similar to why did O'Neill have 10 internal money managers? And Bill told me that the reason he did this is because that at any given time, they're going to have one or two guys that are going to be off track for whatever reason. And you're going to have one or two guys that are going to be really on track, and they're going to just be cleaning up no matter what's going on. And that was the case, really. I'd have to say at different times I could have been in either one of those camps. And what happens is that the group overall balances itself out. So, while the MDM may have issued a buy signal on Friday, I've got another story to tell, and we'll discuss it, and vigorously. So, and I don't call Dr. K too many names, and he doesn't do it either. I might have a couple of good ones, but that's about it. And we kind of come to a conclusion. So the conclusion we've come to is that you cannot, I guess unless you're really drunk or just stoned out of your mind, there's no way in hell you can sit there and look at this chart or the NASDAQ chart and tell me that that's a buy signal. There's no way. If anything, it's a neutral signal, and it may even just be a big reversal off the peak that's a sell signal. But we'll get a better idea over the next couple of days. The market direction model is having problems, and my view is it should move as slow as possible until it's able to work through those problems or the environment stabilizes to a point where it acts more normally. That's just the way I would approach it. So, but it amazes me, and I think this is the danger of being in my position, is that people think that you're omniscient and everything you do is gospel, and what you say is gospel, and if you just mindlessly follow someone, you're going to make money. And I don't think that's true. I think you can learn from people who've spent a lot of time doing this, and it helps shorten the learning curve in terms of and also preventing people from making the same mistakes. I felt it was very important for me to discuss how badly I screwed up in 2009 trying to stay short financials off the bottom in April and getting whacked pretty good, because I felt that if I went through that, people could read the book and learn from my mistakes, and that saves you, the reader, from making those same mistakes. And my pain will not have been in vain, so to speak. Anyways, so no, we don't. They would take we've known each other for a long time. We've been close friends for a long time. No way that that would get in the way. So, but we can definitely argue the market and come out with a constructive agreement. So the thing is, on Thursday morning, we both agreed that the danger of a bull trap was very high, and so I was surprised that the market direction model went to a sell. But it's going back to at least a neutral over the weekend here. You'll see the alert tomorrow morning, and that's that. So quick bad signal. I mean, come on. Even I tested out some stocks on Friday on the long side. So I thought, oh boy, workday coming down to the 200-day right here around 82 and change, and once it couldn't hold, I'm gone. I thought Facebook might undercut this low here and turn a rally, and so I buy a little right in here, and it just doesn't happen, so I'm gone, and I'm flipping back to the short side. So I think it's okay to be wrong temporarily as long as you recognize your mistake very quickly and reverse your decision based on the facts. Anyways, is there info on your site about the software we're using and how you use the 620? No, not really. I mean, if I can be honest, I talked about 620, but I'm almost sorry that I started talking about it. I should have just kept it as my little secret, because people, they want to look at it, and this is getting back to this whole guru thing I'm talking about. People want to look at it as something that's a magic tool, but it's just a rough reference guide for me when I'm shorting to help me stay out of trouble. And I'd have to say that if you were short LinkedIn on Friday morning and you see it come down very quickly, and then you see this move, you've got to be taking some defensive action, because I know these things can snap back in your face and they can be running up very quickly. And you might think you're all fat and happy here, but if this kept going, let's say this had set up and turned on higher, which could have happened, you'd be in trouble. But it basically just keeps me out of trouble. And I've developed some ways of operating with this chart based on my practical experience. So you got to use it, and you might end up tweaking it and changing the periods on the moving average or the MACD or whatever. But to me, it's roughly in the ballpark, and it works. That's all I know, and that's all I need to know. And I can interpret it and come to decisions based on what I'm seeing on this chart and also what I'm seeing on the 620. I'm sorry, on the daily chart. So, so for example, here's Pandora. And it comes down, it gets down as low as 27.50 on an intraday basis. But we look at it, what's happening at the same time. It's coming down to the 200-day here, but it's also, and you have to check your weekly charts as well. So we'll pull up P on the weekly chart. Notice it's also dipping just below the 40-week. So for me, given that you have that going on the weekly and the daily chart, and now you're seeing early in the morning a MACD stretch, and then as you roll over again, you could come back in short in here, and then once you turn here, you got to be covering because this hit a low that also is coming off of the 40-week. So I use the charts in tandem. It's not a magic system. You know, people want to ask me, do you buy when the line crosses over, or do you buy right after? It depends. You know, I might buy or cover or whatever before or after, or even before that if I'm seeing what I call the MACD stretch, which is, as we see in LinkedIn, here's Tesla. This here, early in that's a MACD stretch. You got a -1, -2. It's getting down close to -2. That's about as bad as I've seen it. But I think it was also a sign of just how weak things were. And once the seller goes away, they're able to lift it. And I think you draw in some late shorts in here, and then it just blows apart because there's no bid after that. And to me, you know, high PE stocks getting decimated the way they have tells you that we may be going into a rising interest rate environment. We may be going into a higher inflation environment. So, I mean, go to the store. I'm amazed at how expensive things are at the store. Looking to short WX or China stocks too volatile? Well, number one, if you read the book I wrote for Bill O'Neill on short selling, how to make money selling stocks short, you wouldn't be messing with stock like this to begin with anyways because, let's see, I hope I'm right here, I better be. It trades 758,000 shares a day. 50-day average volume, 758, 130. I don't short stocks these days that trade less than 1 million shares, and preferably not less than, say, 2, 3, 4, 5 million. The more the merrier, and the easier it is to work a position. That's what I'm talking about. You know, Sienna. Let's look at Sienna. Trades 4.1 million shares now. That's a nice juicy stock. That one I can hit 5, 10,000 shares. Click, 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 and I'm short big time, very fast. And if I need to get out, you know, a few clicks and I'm gone. I don't need these things that jack, you know, 3, 4 points very quickly because they trade 300, 400,000 shares a day. So no, you wouldn't short a name like WX. So, but that doesn't mean that China stocks aren't shortable. Look at Baidu. Baidu, look at this. You know, you're getting this is a late stage failed base probably, going code red, but you hit the 200-day, undercut this low. See that? See how that works? And then you bounce. Oh, I gotta get rid of this. And then so you undercut the low here, and you get to the 200. Now this is a big neckline, and you're seeing kind of this could turn into like a head and shoulders, but this thing looks like it's had its bounce, and now it's heading lower. But that's one. It's nice and thick, and you can short that. So another one that might be shortable. I'm going to check this. C-Trip trades 4.3 million. This thing looks like it's going to fail to me. You get short it maybe here, but you're using a high up here as your stop, and that's 52.98. You close at 50, so it's about 5% higher. I don't know if I like that. I think what you'll see happen here is you're going to see the other stocks that have been holding up, like the financials, like the semis, they're all going to start coming off their peaks, and you sort of saw that on Friday. You know, like looking at Microchip, for example. There's the break off the peak. So, you know, now what they're doing is they knock down these high PE, high flyers so much that now they're going to come after everything else that's there. And that's why you're not going to be safe holding a stock like this. And you're not going to be safe holding a stock like Microsoft. Because you see that big break. So, you know, there's no gain. So don't be dumb. Go to cash or go short. That's all I think right now. Somebody says everybody's got one and they all sing. No, mine smells like roses. So, do you sometimes provide a seminar to learn your investing style? Well, this is it. Given post-panic mode, is it better play the Fallen Angels or something like Finisar? That's a good question, I think. Well, you notice this is holding the top of the base, but it's risky. But if the market turned, you know, if you're down here at the top of the base, this could be decent for a trade back to the highs, and that would be a 10% move. So that would definitely be there. I like this so far because it's holding above the breakout point and the 50-day moving average. And also look at something like an iRobot. Let's see how that guy did. See, he's breaking down, but he's still holding roughly the top of this base, which is here. And if we go to a weekly chart, I personally I like this format a lot better than doing real-time webinars because the market shifts so quick these days. I'm not so sure, that's all that useful. Now here's iRobot. Let's check this out. Here's the long-term weekly chart. So you can see you have this big base here that it's holding on top of. But this all looks pretty ugly to me. You can see the big volume weeks. You got this one big breakout that probably scrambled the shorts, and then here, you stall big time here. You stall big time here, here. So you're stalling all the way up in here, so it could just fail. But if it holds and the market turns, then I think you might get a rally out of something like this. First Solar is holding up tight in the little flag here. Okay, so this broke out. Oh, but I did want to point out one thing on iRobot. Sorry, I tend to get distracted with myself sometimes. But if we go and look at this, you can also see, whoops, this is a long-term pattern going back to, looks like March or April of 2011. So it's coming out of this whole formation. So we'll have to see how this holds up. There's a potential for this to just go sideways during a market correction, and maybe it's one of the first things to come out. But right now it's holding, so it is in a better position, I think. But that said, I think something like a Workday, which is not exactly a thin stock, but it is a fast-moving stock, it potentially could have a sharp move to the upside. Some of these, like even Facebook, could have these big, giant moves higher, but they're going to be tricky to play, and the only way I would play them would be on a 620 chart. So, like I said, follow my tweets and follow me in the chat room. So, you could be some of these fallen angels, as you say here, Mike, could be the ones you want to play. So somebody says, what is your second shortable pattern with the biggest expectancy except H and S? Well, I look at every pattern at any point in time as having a roughly even chance of going one way or another. Maybe you got a little bit better odds in your favor depending on the overall trend. But, late stage failed bases work pretty well. That's another pattern. But you should go and read the book I wrote with Bill O'Neill, as well as Chapter 6 of the book that Dr. K and I wrote, talking about short selling. And I'm trying to remember. Let's see. I got a copy right here. Let me take a look real quick. Let's see. Riding the Bear Wave, Chapter 6, Timely Tools for Selling Stock Short. And that'll tell you everything you need to know about patterns. I am using a new thing that I'm using these days is the Livermore rule in reverse. So that works pretty well. And the easy thing here is, let's go to Yelp. And you guys are on the chat room, or those of you on the chat room, you remember when I was telling you I'm shorting this thing at the, at the 100 level. And it came down right around here. I was shorting it, and it came down, undercut here, so cover, then rallies back to the 10, you short it, bounces off to 50, rallies again, short. So this one you could be playing all the way down, and that's how I like to mess with them. But the other rule is, how do you short at highs? I've always been looking at ways to short at highs and trying to develop some techniques for it. But the easiest one to me is, something fails at the 100 level, you just short it right there. If you're hitting it at 98, 99, what's your stop? Well, 100. So it's pretty quick. Maybe you add another couple of bucks on it. But that worked pretty well. Look at Coors. Coors has never been able to clear it. And to me, this is looking like it's heading lower. Look at the violating the 50 days. So this looks to me like you're going to turn into a big head. If I had a rally back into the 50-day, I might look at shorting it. And I tried to short it on Friday morning because it was hanging up here, but I couldn't get a borrow. So. Would you mind walking through an example of a long from the passage, how you wrote it and when you got off? I don't, I don't use typical, the whole baloney, the IBD baloney about, buy 2% here, buy 2% there. What I notice, stocks tend to have these very fast moves, and they run up sometimes 20, 30, sometimes more over fairly rapidly, and I play those moves, and that's what I do, and I rotate around, and then I look for new setups, and I go there, and I just move around, because that's how this market has been acting. The idea that you're going to build a position in something like this, okay, is kind of silly. And I remember someone on the pullback emailing me and asking me, how should I, where should I add to Fay on this pullback, because I'm trying to get a long-term move out of it. Well, all I have to say is you missed the double here if you held this all the way. The first place you would buy this and I wrote in my report here, based on this, I thought this was a pocket pivot because this day here, even though you can see the volume is higher, that was actually a day that this was there was a index rebalancing, so the volume was skewed, but also held tight, so, and came off the low on the daily price bar. You can see that more or less. Let's see if I make it real big. You can see here it closed in the upper part of the price bar. So I look at this as a pocket pivot. But you're coming up to the left side here. So as I wrote, I think on this day, a pullback down to 42 or better would be your buy point. And some people actually did buy it on this pullback, and then boom, you get a viable gap up. So you could have been buying again at the viable gap up. Now you go tight sideways. You bump into the 10-day, and it looks like if it comes off, you could be buying it there. You know, and then I think I was dumping this thing as it moved up in here, and then it comes around, but it fakes you out here, and then you get tight in here, and you get the volume drying up right here. And I actually wrote about this as possibly, no, I'm sorry, right here, you got the volume drying up, and I thought this was viable here, and so boom, I'll come back into it. But I'll play these sharp moves and then bail out. I don't go in and, oh, buy half my position here, then add 2% when it goes up 2%, then a little more, the other 1/3 here, and 1/4 here, and 1/8 here. To me, that's all bullshit, because by the time you get up to here, you got a big old position and they blast you. And that's what CanSlim gets you these days. As far as I'm concerned, CanSlim is dead. You can just shelve it. Do you close your shorts at the end of each day? Sometimes, yeah, if they trade continuously, that helps, but I generally don't carry too much overnight, just because of the way this market is prone to gaps upside, to the upside and the downside. And I'm trading very rapidly. So, have you expanded your pocket pivot time frame from 10 days to 5 days and 3 days? I have looked at 5-day pocket pivots. Dr. K still goes with the 10-day, but I've studied this, and in this market, I think a 5-day pocket pivot on a sort of a deep doo-doo pattern. I'll show you what I'm looking at. Down in here, you know, this I think was this is a 5-day pocket pivot here, and starting to come up, or this one was at least 5 days. See, it's less than 10, but it turns and goes, and you know, but to me, it's neither here nor there, you know, because again, what you want apparently is you want to know that a 5-day pocket pivot is a sure buy signal that's going to lead to immediate gains. That may not be the case. It may fail. All I want is something that's telling me I have a reasonable chance of the stock coming up and out of the pattern if it's been forming a base. That's what this guy was doing. He's rounding out a low at the time, you know, and it had come down. You know, it was a hot IPO, and then it needs to work out all the morons who are buying it on the IPO and buying it high, and you're just getting rid of all of them here as you work this out. A lot of volume in here for a couple days, and then you start getting pocket pivots in here as you're turning, and I'm sort of watching this along with this, and it's turning. Notice how you're going code blue. Everything's turning blue here, and you're getting a 5-day pocket pivot. If I see that, I'll give it a shot. It doesn't mean it has to work. So, but it's not all within the context of this chart. So, can you discuss the number of positions and or position sizing when shorting? I don't know. I might have 2 to 3 to 4. My general view is the fewer you have, if you can be accurate in your selection, the fewer the better, because when things turn and you got to cover fast, it's a lot easier to just cover 1 or 2 positions very quickly rather than having to bop around and type in different symbols, unless you have everything all set up on a trading platform, which makes it a little easier. But I may go, you know, if I think LinkedIn, and I've done this several times on the way down, on days I'll go 200% short the stock or more. If I, you know, I'm turning the couches upside down to pull out every little bit of buying power I have and go short. That's how I short. You know, I'm not into position sizing. I think position sizing is for people who don't really know where things are going. So I like to be aggressive, and I keep my stops tight, and I've developed ways to control risk, like the 620 chart, and I'm just very aggressive that way, and right a lot. At least I have been recently, and when that happens, it's a beautiful thing. But when you're not, you got to have pretty tight risk control, because if you run 200% positions and something snaps on you, you can get hit pretty good. So number one, if you take big positions like I do, you want to have a nearby reference point or something, a tool like the 620 chart to tell you when to cover. and avoid getting smacked on the upside. And number two, you want to pick very liquid stocks that you can get in and out of very quickly with a large position, and have the liquidity you need to traffic in a large position. So that's the way I operate. You know, people ask questions like, here's one. When covering your short, are you waiting for a 620 crossover to the upside on a 5-minute, or do you sell when the 5-minute MACD is stretched to the downside? As I was talking about, and I use P as an example, Pandora, or all, as I like to call it now, P is for pounded. A is for apple, B is for boy, and P is for pounded, especially over the last couple days. Again, I'm using the 620 chart in conjunction with the positions on the daily chart. So, and this is something I talk about in chapter 6 of the book. So you want to study that because it's all used together. And you know, acquiring skill in short selling takes time, and sometimes it's going to cost you some money too. So you got to pay some tuition. But it is definitely very rewarding. But it's something that you have to learn to deal with, given your own psychology. I can sit through a lot. I can sit through fair amount of pain usually, and I'm not afraid of a 10 or 20% drawdown because I know I can move that much in a day. And I have the confidence now, and I have to say my confidence level is back up to what it was when I was at O'Neill, after having problems with trying to run other people's money, which is a completely different thing for any trader, no matter how good you are, because psychology is a very fragile thing, and once you have clients whose psychology also comes into play with them freaking out and sending you 20 emails a day wanting you to explain every little thing you did, that just screws you up. And so, you know, it wears on your confidence. And just getting back to just trading my own money has given me the confidence to make a lot of money very quickly and to take the risk where I think it's warranted, and not worry if I get hit with a little loss. You have to lose to win. That's my motto these days. Somebody says, the reality is there are a number of ways that the 620 can be used. That's true. Actual crosses, MACD stretches, etc. It all depends on the context of the market. Brad, that's your Dr. Brad, I might add. You're dead on. You're dead on. I mean, you got to learn how to use it, and I really like to see the fact that somebody gets that. And as you also go on, this is not by numbers, not paint by numbers. It is a guide. It can give you an edge, but there are no absolutes. So somebody says audio breaking up badly. That's probably a function of your internet. Hopefully we get a nice recording here. So far everything looks pretty smooth. Someone says, I find the webinars are more productive when outside market hours. Yeah, I think we might move to a format like that. Somebody says, do you play with 620 on the intraday chart for the snapback you were talking about 5 minutes? Well, 620 is a 5-minute chart. So again, it's a 5-minute chart. So 5 minutes, see? And you use a 20. This 45 I just get rid of. I don't know who put that there. I think the reason I put that there is because it corresponds to a 10-day. Maybe not. I'm trying to remember, or I forget. A daily chart. I don't know. No, I don't know why it's there, to be honest with you. But we have a 20 period, a 6 period. Forget this MA 45. I'm going to get rid of it right now. So let's see, MA 45. Goodbye. And it's not there anymore. So, okay, and you got a MACD 620.10 close, and you're using the various movements here. But you get a sense of how it's basically sort of an oscillator. When things get very oversold on the short side, that's usually when you want to be covering. I call it using the liquidity crush to get very nice exit points. Have them selling stock to you as you're covering rather than you having to scramble to cover on the upside. So, you really want to be, as this is coming in and getting the MACD stretch, if you're covering into this or covering quickly on this bar, as soon as it starts to reverse, you're out pretty good. And then you can think about coming back in. What do you define as a tight stop? I think it depends on your own psychology and how big the position is. A tight stop on a 10% position could be 10% because the net damage to your portfolio on that move is 1%. I'd look at it in terms of how much I'm willing to lose in my portfolio. So if I got a 200% position, a 10% move in that is going to hit me for 20%. Okay, so I'm thinking I can tolerate 5%, so 2.5%, 3% comes into play, and that's why I use that number a lot. I might go 3 to 5 on a 100% position. So the other thing is, where are your reference points in terms of where are the nearest moving averages and whatnot. Someone says, are you going to post this webinar? Yes, I'm going to. Audio is fine, everybody says. Somebody says keep on Sunday. Yeah, but you know what? I like to relax on Sunday. It's a beautiful day here, too, in Playa del Rey. I don't know what the rest of you are dealing with out there in other parts of the country, but it is perfectly clear. It is crystal clear, in fact. I was already out for a run earlier today. The sun is out. It looks like we're going to be mid-70s and looks good. I do plan on being at the HGS Investor Seminar in October. So, I want to see more of you guys get out there. I think we need a bigger crowd. I keep wanting the crowd to be big enough so that they can hold it at the Terranea Resort. Terranea Resort. Go look that one up online. It's on the Palos Verdes Peninsula overlooking the ocean. Nice big resort, but you got to have the numbers. If you only got, I don't know, 50 or 100 people, I think that Palos Verdes Library is the best place because it's relatively cheap. But if we could get 200, 300, 400 there, maybe they could afford to have it at the Terranea Resort, which I would like. And we could get a room there and just make it a party for the weekend. How would you describe the difference between Gilmore Report versus VoSI? Well, VoSI is a real-time alerts site. We put out real-time alerts. So Gilmo is just a twice-weekly general discussion of the market and various strategies. So you've got to take that and then apply it in real time. If you want more guidance, you get VoSI. My view is you should just subscribe to both of them and the webinars. Take it all. I like it. Somebody said, this is a great webinar, wonderful webinar, Gil. Just absolutely wonderful. Wow, you sound like the that scene in the movie 2001 Space Odyssey when they're asking the guy, what's going to happen? He says, something wonderful. Maybe I should start my webinars out that way. Somebody says, I used the 1 minute 620 with the 5 minute 620 on P Friday. It was very noisy. No, I don't do that. If you think about it, using a 5 minute chart could just be noisy in and of itself. So if you can simplify that and just use that along with the dailies and what's going on the dailies, then I think that's what you want to do. So somebody asked, a webinar on your daily routine. Yeah, you want to know my daily routine? Here's what I do. I go to these lists, and every day after the close, we're going to do this. It's 11:12, so I'm kind of going over. So I'll go until my wife screams at me to come and get lunch. But let's go to smart groups, and they are very smart groups. And I go to two of my favorite people, Ian Woodward and Ron Brown. And you go to stocks moving to the upside and the downside. They actually have stocks moving to the downside, $1 to $15. I just use this, stocks moving to the upside. And I look at these lists every night. And they don't seem to be fixated on useless canned slim characteristics. Because let's face it, some of the biggest moving stocks over the past year have been things like Tesla, no earnings when it started. Solar City, no earnings when it started around 19. No earnings on Workday, on several others. What was another hot? The 3D stocks, had big moves like X1, but their earnings were kind of weak there. But I go through this, just boom, boom, boom. Look through charts. I use my secret weapon setup here, and just looking at what's acting well. So on Friday we go through this. Camden property charts, like that. These are the things that were acting well. This is a short list, I can tell you that much. Celanese, I hope I'm pronouncing that right. Cemex. I think there was a buyout in the group, and that got all the cement stocks hot on Friday. CLR, the oils are trying to act okay. Copa Holding, to me this looks like a Head and Shoulders, and this is a short here. So what's a symbol on this guy? We should write this down. Let's go through these real quick and see if we can't come up with some new ideas. So take another 10, 15 minutes or so. But that's about how long it takes. So this is kind of my daily routine. You can see what Credit Corp is acting well. That's a piece of garbage. CubeSmart, Deere and Company, but probably that's going to turn out to be a fake out. Digital Realty Trust, that's looking like that. These are things that were strong. So you get a sense that, okay, if this is what was acting right on Friday, that was a lousy day. Dresser Rand, DT Energy, try to stay awake. These names are going to put you to sleep. Here, EXP, there's a short. Double top on a faulty little double bottom. It's going back to the 50-day. I'm making notes here. I don't know about you guys, but let's see. Nothing exciting here, though. Nothing. Even though they're moving up, like I said, in a down market, these things might be trouble. Here's First Solar. It's holding up in a little flag. So, but it almost looks to me like it could fail. I don't know. That's one to keep an eye on, though, as a possible buy idea. Let's see, FMC. Gas log has been acting pretty well. General growth property. I think these REITs, I think they're going to be trouble. My friend, now I'm forgetting his name, Keith, the real estate analyst, who's been dead on over the years. He thinks all these commercial REITs, these retail REITs, REITs like SPG, Simon Property Group, that own malls and whatnot, that he thinks they're ready for a big fall because of the vacancy rates and the fact that the retail sector in general is slowing down, and that they're also wildly leveraged, so issuing huge amounts of debt. So he thinks they're ready to implode, and so I think you're seeing some of that in the housing sector. Housing stocks aren't so hot. Headwaters here. These are all doggy. I mean, these are terrible. You know what we should do? Let's look at, here's the way I like to do this. Let's go to the warehouse view, and we'll pull up the list from there. So stocks and groups moving to the downside on Friday. So what I'll do here is take the ERG, and wow, these are ugly, and start looking at something. That's a short, but it's a thin stock, 560, but that's a short pattern. Here's another one. These Chinese stocks aren't looking so hot. Arrowhead Research, doesn't that look ugly? Auto Home, that's looking ugly. Here's one, Enanta Pharmaceuticals. These are all thin, though, so I don't think they're shortable. What's this? FireEye, looking pretty grim. Maybe getting near a point where it's going to have a reaction bounce. Global Eagle. This might now be starting to look more like a Head and Shoulders. Somebody thought this was, but it didn't really pan out, and it broke out, and now it seems like it's rolling over. I mean, so many things look like a short. Now, if you look at GoGo on a weekly chart, I don't know if I can always make something look better than it is. Okay, here you got left shoulder, a head, and now a bunch of right shoulders, and now this thing's just going to head back to 10 bucks. This almost looks like a short to me as well, so it's kind of on my short list. And it's pretty thick. It trades pretty well. Okay, where were we? Hilton Worldwide, that looks pretty grim. Intrexon, KCG. These are all roughly thinner stocks. But I'm looking, I sort them by ERG rating here, and I got the highest at the top. So what I'm actually looking for are strong stocks breaking down. What I'd like to look at now is my short sale watch list. And you can see these are all breaking down. Most of these looks a little too late to me, and they're thinner stocks. SeaWorld, there's a nice one. Has anybody been to SeaWorld lately? We were there a few years ago, as I recall. No, we didn't get to see one of the killer whales eat somebody, but that could have been fun. I think when we saw that on the news, my son's first response was, "Damn, we weren't there." Let's see. Let's go to my short list. I've got a new short list, 2014-04-07, and here we got 3D Systems. To me, it looks like it's ready to break a neckline and head lower. I try to short this thing. You can see it's a very clear Head and Shoulders. Rallied right into the 50-day. I mean, that was such a juicy short. I have not been able to borrow it. I hope somebody out there was able to get puts. Align Technology, I think this is a short, kind of a pin Head and Shoulders, and you get this rally up in here above the 50-day. There must have been some news there, but that was shortable. This might be a short, probably using a pretty quick stop. I don't think it should retrace more than half of this, so that might be one to look at on Monday. Depends on how things open up. If we gap down, I think the risk of going short at that point. You can see Amazon, here's another one, left shoulder ahead. Big volume breakdown off the peak like that, and now you're just forming a right shoulder. And I was on the chat room, at 377, I remember, telling people I'm shorting this thing, and right in here, and it's blown apart. So for those of you who aren't in the chat room, you really should try to get there. I'm usually in there maybe 8 o'clock my time, sometime around there, 8 to 9. And I might be in and out. Some days I don't bother to go in at all because I'm busy. Apple, to me, looks like it might be breaking down. And this might be a short. It's trying to hold the 50-day here, the blue line, but you're going code red. And if they take the market down, they're going to take Apple down. And I don't really see what's so great about Apple. I think the whole wearable technology thing is a bunch of BS. It's overblown. They don't really understand how it's going to work, and I don't think it's going to be as big a thing as people think. Baidu looking grim, like it wants to bust. So if you wanted to short this, if it's anywhere near the 200-day, you could try it using a quick stop at the 200-day. So, but I'm really wary of telling people to get aggressively short here. You might test some things and see how they go, because the bottom line is, I've been talking about the short side of the market for a number of weeks now on these webinars, and I've given some ideas, Gilead, LinkedIn, among others, Pandora, several ideas on the short side, and they've worked out very well. So if you weren't going after them now, think about this. If all of a sudden you're all hot under the collar to get short, we might be getting to a short-term exhaustion low. Now, the good thing about that is it'll create a rally in the market that will bring all these short sale targets. So you can copy down what's on my short list here, bring all these short sale targets back up into, say, a 200-day moving average where they become shortable again. Now, it might take them a few days before they roll over, but that, once you have the break off the peak, and the beautiful thing is, as far as I'm concerned, if you read Money Selling Stocks Short, we talk about the fact that you want to watch the market. The first big break off the peak is going to produce a rally. And so what you want to be doing, you know what, I'm going to shut some stuff down here. Just because they're telling me I'm getting a little. I wonder if my daughter's on Netflix or something. Shut down some stuff. What was I saying? So, you want to use the rallies to come after these shorts, and so that's why the first rally after a big break is something to watch. And you go back to, say, let's go back to, where are we? Okay, I want to go back and look at the NASDAQ. Where's the NASDAQ? It's not on here. Okay, where do they have it? It must be up here. There's going to be like 500 indexes show up. Here we go, NASDAQ. Okay, what's going on here? What's wrong with this picture? Here we go. Go back to, okay, that's going to give me the circle of death. Getting the white screen of death now. Oh, can everybody hear me okay? Okay, here we go. So let's look at this. Let's go back to, whoops, a little bit too far. 2007, and we can see that in October is when the market top. Actually, it was a double top. It's trying to make a new high, and then we rolled over here. And so you had the first big break off the peak, and that resulted in a break like this, and then a rally, and then another breakdown. And then you spent some time chopping around. It was during this period in December that a lot of stocks like Crocs, for example, you go back to that Crocs example we showed on the weekly chart earlier, had rallied up into, in that case, up into the 200-day moving average. But that's what this will create. And it's choppy, and it can whip you around, but you're basically watching for that. And off of here, I kind of see the NASDAQ in a similar position, having tried to, it broke down and trying to rally back, and now it's rolling over again. Whereas the S&P is near, went to new highs, but the NASDAQ has been relatively weaker, and I think that's telling you that if we do get any kind of a reaction rally after a short-term exhaustion low, you really got to be looking at shorting into that. So we'll see how that all plays out. Let's see, continuing to go through my short sale list. Here we go. Whoops, nope. That was S&P small cap 600. How did I get there? Back to NASDAQ. Here we go. Oh, I see what's going on. I'm confusing it. Got to get over here. That's it. Okay. Yeah, so here is the peak No. Where are we? 08, 07, cruising back a little bit. Yeah, so here was the peak in, I'm sorry, I was all wet on that. Here was a peak on the NASDAQ. I knew there was something wrong there. We were looking at the S&P 600. Now we're looking at the right one. The NASDAQ, you see the break off the peak initially. So that was, your big bust, and then you went sideways for a period of time, and this produced the right shoulders. So the right shoulders will generally, you'll see the heads form as everything blows up off the peak, and we've seen that over the last month. Notice how the NASDAQ, you had a bull trap here, and you might say the S&P did that more recently, so what we're looking for now is some sort of exhaustion low, then some chopping sideways in the indexes that coincides with a lot of these names that have broken down on their peaks and showing the right sides of heads in potential head and shoulders patterns that are in process or in the making, okay? And then you want to watch how you'll see the right shoulders will probably form during something like this, okay? And that's essentially what you're going to be looking for. So let's see, getting back. What happened there? Oh, that's a nice sound. Oh, forget that. I don't need that. I accidentally clicked on a, okay, that's not it. How about this? Here we go. There's a Citigroup, okay, and I think this is a short using, if it rallied into the 50-day, that would be beautiful, but I think that's a short. I think Goldman Sachs is a short. CRE, you get a bounce up to the 20-day. You notice resistance is also here along the 58 level, so that's a short. If it rallies up in there, that's where I prefer to hit it, but this thing might blow through the lows this week. GameStop, somebody asked me about this during the webinar, but I got to be honest, I was just too distracted to really give an intelligent answer. But on something like this, it's a breakdown pattern. The bottom line is, there was a juicy time to be short the stock. Now you get the rally here. Sometimes these can be secondary, much later entry points, and so it did reverse off the 200-day. So that would have been a good short near the 200-day. Now you got a big outside reversal day. Is it going to continue to blow lower? Maybe. Goldman, I think, is a short. Use a 50-day at around 163 and change as your stop. There's my short index. LinkedIn, I think, is headed for 160. That's the point I'm looking to cover it. Lulu might be shortable if we shrink this. You can see this has been breaking down, but you're rallying up in here near the top of this gap. This might roll over again. Whoops. Lumber liquidators. I've never been able to borrow this thing, but this was a short. On this move here, when it went code red, see that right there, and then boom, it's come down. So it might head lower. You might try EXP though. Michael Kors, I'd be shorting into a rally here, but it may head lower first. Nation Star Mortgage rallying up to the 65-day, but now starting to roll back through the 50-day. Maybe this goes lower, but this is a much juicier short up here. I've just been watching it. Netflix at the 200-day. So this, in my view, left shoulder, big head. Now you're in a position where maybe you undercut this low next week. So you could try a quick trade if it's not gapping down on Monday. You might get a move through the down below these lows, down to say 320 or lower. What's the low here? 320, yeah, 25. So and you closed Friday at 328. So that's a. No, I'm sorry. You closed Friday at what am I doing here? Close at 337. So that could be some nice move there on the downside to trade. But be cognizant of the fact that if you do come into some of these names, you're approaching the 200-day line. You could go through it. If that undercuts a prior low like this would, then that would probably be the spot that you're covering. But that's pretty grim looking. I mean, this isn't what these stocks were doing when we corrected last in January. In fact, Netflix was looking like it was correcting with the market, then it had a viable gap up. And this is the difference now. You're not seeing any of this stuff. Earnings season is coming up, so maybe we'll see some weird gap ups occur on earnings reports, but my general view is market's screwed. Aquin Financial shortable here. See the 50-day. This is late again though, but here you got a pinhead and shoulders. And if you guys recall on the chat room, I was right here I think on this day telling you this is a short because it was going code red and starting to look like it was all switching red here. I think we went code red that day, so that was what I was looking at. And you had this dark red kahuna, which is a negative sign for a stock and an index as well. And then things just blows apart from there. So I traded it down and then covered it, and it just kept going further. So all I have to say is if you make money and you can make decent profits, 20, 30, 40% on the short side, be happy. because it's tough, and where you cover, a lot of times you're covering, and in hindsight, it's a smart thing because the stock will turn and rally sharply for a few days, allowing you to short it again so you're happy, or they'll just keep going lower and you'll be ticked off that you didn't sit with it. Price line coming down, maybe again, it's a situation where you might undercut this low here and bounce off the 200-day. So, that's a potential short as well. I don't have a lot. I want to finish this up and then we'll wrap up here. Kihu, again, see this? There's a head. Might call this left shoulders. You have a lot of support over here on the left side. So this my guess is you may come down to the 200-day and you're going to bounce around for a while because you got all this to eat through, this support in this long base, which is about 4.5 months. Now, if you see some patterns like this and this thing just blows right through support and the lows of this base, that tells you how weak things are. And I have to admit that the action of the leading stocks over the last week has been like that, so weak that you have to wonder what's wrong. There's Cena, that was a short before. Stratasys, I think we put that out as a short on a SSS report, short sales setup report, and it was short right at the 50-day. Now you're at the 200-day, but my guess is it's going to go through and at least push down to this low and undercut that before you see some kind of rally back up into the 200-day. And it could get ugly depending on what the indexes do. Data, I think, is in a position where it could bounce, but I'm gonna wait until I see some kind of exhaustion low in the market and a panic low before I start looking at the long side, and then we'll see what kind of position things are in. Let's see, Tractor Supply, I think, is potential head and shoulders. Okay, so you're rallying up here, you're going through the 50-day. That looks like a short. You could use a tight stop at the 50-day, but this looks like it's finally topping. Trulia, I think, has been building a head and shoulders for a period of time. Let's go back real quick and just I want to look at TSCO. You can see the head and shoulders here. See that? Pretty clear. Left shoulder, head, and you got the big volume break here. Right shoulder starting to break down. It's a short. It's probably heading down for this low. Maybe it's the earnings report that finally kills it. You can see that. Look at Trulia, for example, now. This is a head and shoulders. I actually pegged this one here, and that was in my report, and it got nailed, and then it broke down through the 200-day and rallied back up, and it's broken down again. Now you're trying to rally up into the 40-week again, and it looks to me like it's heading back below. This is housing related, and I think housing, I was told that the housing numbers dropped like 22% last month. You haven't heard too much about it, but it was a pretty surprising drop in sales. So that's what this company relies on. You've seen the ads on TV where you're able to use their app to look at houses, and I don't know what else you can do. Visit them virtually, I don't know, whatever. But I think if you get a market breakdown here, this is definitely heading lower. So that I would look at this as being shortable. Let's go to the daily chart. What is that? No, I'm going to get rid of this now. We're done with that. Where are we? Here we are. Yeah, and so you see the daily chart. It's actually been trying to rally, and you even got like a pocket pivot, I think, in here. But it's failing, and so I look at this as being shortable in here. And you could use a tight stop at the 10-day line, which is looks to be around 34-ish. Maybe you have a little bit of room here, but it looks like it would break down, like it wants to break down. You're starting to turn red on the 13-day and the 2-day force. Somebody says, do you use market internals for intraday action? No. What are market internals? Like, they don't tell you anything. I don't get into using all this BS, trend and ARMS index, and advanced decline line is a useful number only in the sense that if the market's rallying and you see decliners are leading advancers, that's a problem. So, because it's telling you breadth is narrowing as the market's rallying. But intraday, I don't use any of that stuff. You don't want to get too complicated with things. You want to try and keep things as simple as possible. And for me, over the last 8 years since leaving O'Neill, when I was at O'Neill, it was a pretty simple situation. I had one screen of quotes and my wand up, and I wanted to place a trade. I had to call our desk. I wasn't able to go click, 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 and be in or out of a position. I had to actually do things slower. And it was pretty simple. And then when I started to run hedge funds, and you get prime brokers, and they've got all sorts of platforms and indicators like heat indicators, that show you how hot a move is or something. There's nothing worse than having a heat indicator that's a red bar that's like turning into the Liberty Tower and just getting really big to scare you out of a position. And all kinds of research and reports and this and that. And I got very complicated, and then thinking that I needed to have several monitor screens. Now I basically have two, one to watch the market and the other one to look at porn. No, I'm just kidding. To look at charts. Oh, did I ring a bell with a few people there? Okay, let's see. How long do you hold your position if you're short? As long as I think it's profitable, but I trade in and out on a daily basis. And yes, I trail stop losses. I use, like for example, on LinkedIn, I've been using the 10-day. Once I got short in here and it broke, on this rally I figured, okay, I'm going to get short again because I'll cover after a couple, 3 days long. Here, you undercut this low, okay, so you can cover in here, let it rally up to the 10-day, it gets up here, I short it again here, and it rolls over. And I'm actually coming in short heavy here, cover most of it. I've been holding some of this overnight the last few days. And then the next day come in short it again, it breaks down. The next day come in short it again and get my position big again, and I'll do that. I'll trade them that way. So, but if you're running smaller positions, you can do quite well sitting with them if you catch the right time to go short. So I can tell you that in 2001, I went short around mid-year, and I was only about 35% short net overall. I was short stocks like Qualcomm, Microsoft, Broadcom, Brocade, and I think Checkpoint Software as well. And I only had like 5 to 10% positions in those stocks, but I actually made 30% net by the time it was all over, and the market had bottomed. And this was in the O'Neill account I was running, and the market had bottomed right after 9/11. But I was in my own account. I was like 200% short, 150% short, I think it was. That was the most I could be short in my account back then, and I was 150% short on 9/11. So I was much bigger in my own account. But running O'Neill's money, I wasn't as. It was a much bigger account, so I couldn't freewheel as much, and so 35% was enough to do pretty well. So if you've given up some money off the peak, if you can short right and have smaller positions and sit with them, because these things do trend lower, when it happens, and short reaction rallies notwithstanding, that you might be able to sit through if you don't have a huge position. I think net you can follow the trend and do okay. And I did that in 2001 running the big O'Neill account, but also I just raked in my own account being much heavier. So is there a good number that is a reasonable trailing sell? I don't know. Like I said, it's all contextual. I'm looking at undercutting prior lows. Again, you need to read chapter 6 of our book, and that's going to give you a better idea of a lot of the mechanics of it. What I'm trying to do here is go through what I'm seeing right now and give you guys some ideas. Hopefully, we've got a few, and we'll see what happens this week. That said, I've been going for an hour and 37 minutes, and it's time to go. It is Sunday after all. Anyways, I do thank all of you for showing up. If you have any questions, you know where to email us, and I look forward to doing this again. I think it's much easier for me to deal with. But I'll do it on the weekend when I think we're at a key juncture. And I did think that I needed to come in and talk about things given the sort of confusion with the MDM and whatnot on Friday, particularly after we had written early on Thursday in the pre-market pulse report that we saw this as a bull trap, which it was, okay? And the funny thing is that the MDM got trapped. So yeah, but that happens. But it'll reverse quickly and get back on track. So that's fine. Anyways, you guys, hope you appreciate this webinar. It's always fun to be able to spew at you all, and I appreciate the fact that you all sit and listen to it. So anyways, thanks for showing up, and I'll catch you guys next time. Good luck.